How smart founders legally slash six-figure taxes. State secrets revealed. Have you ever lain awake, heart-pounding, terrified that a single lawsuit or crippling tax bill could steal everything you've built? What if you could weave a legal fortress around your life's work, protecting your wealth, slashing those fears, and redirecting every dollar back into your dream? Stay with me, because in the next few minutes, you'll discover the surest key to safeguarding your future and igniting unstoppable growth. Welcome back to Mind and Money, the channel that takes complex financial strategies and breaks them down into bite-sized, actionable blueprints. If you're building a startup and serious about keeping more capital in your business, smash that subscribe button and ring the bell so you never miss a money-saving hack. In this video, we'll explore 1. 6 states offering the most lucrative startup tax credits and exemptions. 2. How to qualify and apply for each incentive. 3. Pitfalls to avoid when claiming state benefits. By the end, you'll know exactly which states align with your growth goals and how to capitalize on their programs to reinvest savings into innovation. Why state-level incentives matter. Federal incentives get a lot of buzz, but state and local benefits can deliver even more targeted savings right where you operate. These programs often include job creation credits, dollars off your state income tax for each new job you create, R&D tax credits, refundable or transferable credits to offset research expenses, sales and use tax exemptions, waivers on software, equipment, and manufacturing inputs, investment credits, credits for raising capital or investing in equipment, enterprise zone benefits, property tax abatements, and utility discounts in designated regions. Why do these matter? Imagine shaving 5 to 10% off your effective state tax rate for the first 5 years. That can free up cash flow to hire that extra developer, ramp up marketing, or build proprietary tech. Plus, many of these credits are refundable or can even be sold to other taxpayers, turning a tax saving into immediate working capital. Let's go. Number 1. California, the R&D and hiring powerhouse. Let's start on the West Coast. California, home to Silicon Valley, offers one of the most robust state R&D credit programs in the nation. Here's what you need to know. California R&D credit, worth 15% of qualified research expenses exceeding a base amount. Fully refundable for businesses with under $50 million in annual revenue. California Competes Tax Credit, a competitive credit awarded by application process, up to $100 million annually, based on job creation, investment amount, and strategic importance. New employment credit, available for hiring full-time employees in designated select areas, worth 35% of wages paid to qualifying employees, up to $56,000 per employee over 4 years. How to qualify. Document all R&D activities, experiments, prototypes, design iterations, and track qualified wages, supplies, and contract research costs. Apply for the California Competes credit by submitting a detailed business plan illustrating projected job growth and investment. For the new employment credit, hire in targeted areas like Inland Empire or parts of Los Angeles County, and maintain headcount for at least 36 months. Pitfall to avoid. Failing to substantiate R&D activities with contemporaneous project documentation can trigger audit adjustments. Use project management tools or even a simple lab notebook to record experiments and results in real time. 2. Texas. No state income tax plus targeted incentives. If you're chasing a no income tax state, Texas should be on your radar. While the Lone Star State doesn't levy personal or corporate income taxes, it offers other incentives worth millions. Texas R&D tax credit, up to 5% of qualified research spending, transferable to other Texas taxpayers if you don't have a tax liability. Texas Enterprise Fund, grants and performance-based incentives for major projects that create at least 25 net new jobs. Sales tax exemptions on manufacturing equipment, computing devices used primarily for design or engineering, and certain software. How to qualify. For the R&D credit, track eligible expenses, wages, supplies, and third-party research. File Form R&D 100 with your franchise tax report. For the Enterprise Fund, apply through the Governor's Office with a proposal outlining your job creation and capital investment. Work with your vendor to secure a sales tax exemption certificate. Then claim exemptions when purchasing qualifying equipment. Pitfall to avoid: ignoring Nexus rules. Even without income tax, if you have a physical presence or significant sales in other states, you may trigger tax obligations elsewhere. Always confirm your interstate footprint before assuming no income tax is your only benefit. 3. New York: strategic credits for tech and manufacturing. New York packs a punch with its Excelsior Jobs program, particularly for tech, biotech, and manufacturing startups. Excelsior Jobs Tax Credit. Available for companies creating at least 25 net new jobs or $1 million in qualified investment, offering credits against corporate and insurance premiums taxes. Software Development Tax Credit. Up to 10% of qualified software development costs, including wages and third-party contract expenses, with a cap of $250,000 per year. NYC Manufacturing Tax Credit. For manufacturers in New York City, up to 10% of qualified real property taxes or up to 30% for redevelopment of industrial facilities. How to qualify: submit a detailed application to NISTAR for the Excelsior credit, demonstrating projected job creation or investment. Document software development projects, separating qualified costs, coding, testing, integration, from non-qualified overhead. Locate or expand manufacturing operations within designated NYC industrial zones, and file annual reports to renew credits. Pitfall to avoid: underestimating reporting requirements. Many New York credits require extensive annual performance reporting, job counts, payroll data, investment milestones, so build your internal reporting processes before you apply. 4. Florida: quick start incentives plus no personal income tax. Florida's sunny beaches come with equally warm tax advantages. No personal income tax plus a suite of business incentives. Qualified target industry tax refund. For projects in high-value industries, information technology, life sciences, manufacturing, providing refund of up to 80% of sales and use taxes, 100% of corporate income tax, and local option taxes. Sales tax exemptions. On manufacturing machinery, research and development equipment, and telecommunication services. Capital investment tax credit. A transferable credit for manufacturers, agricultural producers, and tech firms investing at least $50 million or smaller companies in rural counties. How to qualify: work with Enterprise Florida to determine if your business falls within a target industry definition. Prepare a job creation and capital investment plan. No minimum job requirement in some rural incentives. Apply for sales tax exemptions using DR-1 forms at the time of purchase. Pitfall to avoid: treating exemptions as automatic. For sales tax waivers, you must proactively apply and furnish proper exemption certificates. Missing deadlines can result in denied claims and retroactive bills with interest. We're halfway through. If you're already thinking of relocating your startup or filing in a new state, hit that like button and comment below. Which incentive surprised you the most? Stay tuned, because up next I'll reveal 2 under-the-radar states with stealthy benefits, and I'll share the single biggest mistake founders make when chasing these credits. Under-the-radar states: Ohio and New Mexico. Beyond the big players, 2 states fly under the radar but pack a punch. 5. Ohio personalized powerhouse. Ohio R&D investment credit. A 7% non-refundable credit on qualified research expenses, plus a 5% credit on incremental R&D spending. Job creation tax credit. Available against the Ohio CAT commercial activities tax for projects creating at least 10 new jobs in targeted counties. Venture capital investment credit. A 25% credit for individuals investing in Ohio-based startups, up to $250,000 per investor per year. How to qualify: file your R&D credit and incremental credit with your annual CAT return. Engage with Jobs Ohio to access job creation credits. Prepare a recruitment plan and local incentives package. For the VC credit, ensure investors apply through the Ohio Department of Development before making equity investments. Pitfall to avoid: Ohio's CAT is a gross receipts tax. Understanding our revenues qualify or get exempted is critical. Model your tax projections carefully to ensure credits offset your CAT liability fully. 6. New Mexico small business sweet spot. High-wage jobs tax credit. A refundable credit up to $10,000 per job for hiring employees at or above a county's prevailing wage. Technology Jobs Tax Credit. 3% of gross receipts for qualifying tech services, up to $5 million per year. Film Production Tax Credit. 25% refundable credit on qualified production expenses for companies filming in New Mexico. How to qualify? Apply for the High-Wage Jobs Credit through the New Mexico Economic Development Department, demonstrating wage levels via payroll records. Register your tech services business and file gross receipts returns to claim the Technology Jobs Credit. For film credits, pre-approve your production plan and expense schedule. Then submit quarterly reports. Pitfall to avoid. In New Mexico, many credits require upfront application and pre-approval. Missing this step can disqualify your entire tax year, even if you meet all spending thresholds. Before we wrap up, here are the top mistakes founders make and how to avoid them. 1. Insufficient documentation. Credits almost always hinge on detailed records. Don't wait until year-end to compile your data. 2. Assuming uniformity. Each state has its own definitions, filing windows, and reporting nuances. Treat each program as a standalone project with dedicated timelines. 3. Neglecting renewal requirements. Many credits require annual recertification or performance reports. Build these into your calendar with automated reminders. For overlooking local incentives, cities and counties often offer additional property tax abatements or utility discounts that can stack with state programs. Always check at the municipal level. 5. Ignoring exit implications. If you plan to move operations later, confirm how credits are recaptured or prorated to avoid surprise clawbacks. Pro tip: integrate incentive tracking into your ERP or accounting software. Tag each transaction and hire a part-time credit specialist or consultant to audit your filings before submission. You don't need a massive corporation's budget to benefit from these state incentives. With careful planning, solid documentation, and a bit of strategic flexibility, even a bootstrap startup can slash six-figure sums off its tax bill in the early years, fueling faster growth, smarter hiring, and sustained innovation. Imagine reinvesting those savings into product development or customer acquisition and outpacing your competitors. That's the power of state-level tax planning. If you found this blueprint helpful, hit like, subscribe, and ring that bell. Got questions about your state or incentive eligibility? Drop them in the comments. I read every single one. Which topic do you think I should explore next? See you tomorrow. Bye for now.